Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 4 of what is now going to be my 5-part video series on Roth IRA conversions. In this video, we're going to keep adding complication after complication into our tax planning scenarios. And we are going to continue building out our personal tax planning template, including a full IRMAA surcharge calculator, analysis of the 3.8% net investment income tax, and then stock trader after-tax cash flow maximization. Because what's important is not just minimizing your taxes, but maximizing the after-tax cash flow that remains in your family's pocket. And as they say, what gets measured gets managed. So in order to maximize after-tax cash flow, first we have to start our journey figuring out how to measure it. By the way, if you enjoy this video, please like and subscribe and let me know in the comments what's going on in your personal tax planning situation. All right, so let's pick up with our timeline from the last video. So if you recall, the ages that are relevant, 59 and a half. Prior to this age, Roth conversions are allowed, but make sure to pay the tax on the conversion from outside funds, or you may get dinged with that 10% penalty on early distributions. We also had age 73. After age 73, you'll be in RMD territory. Roth conversions are allowed, but you will already have a base level of required income coming from those RMDs, which could cause you to already be in a higher bracket, thus making Roth conversions less meaningful. So within the sweet spot between age 59 and a half and age 73, for Roth conversions, you do have the ability to pay the tax on the conversion using money from the conversion itself with no 10% penalty. That's why we call this the sweet spot. And now we're going to add 2 more ages to the timeline for this video. So the first age is going to be 63. That is when your IRMAA surcharge is going to start getting measured. IRMAA is based on your income from 2 years prior. So each year's surcharge is based on the income from 2 years prior. So when Medicare begins at age 65, the IRMAA surcharge that will apply to you at age 65 is going to be based on your income at age 63, so 2 years prior. And then at 66, it'll be based on your income at age 64, and so on. So we're going to adjust the sweet spot into 2 components. We're going to have a 3.5-year super sweet spot for Roth conversions between age 59 and a half and age 63. In this super sweet spot right here, you have the ability to pay the tax on the conversion with money from the conversion itself with no 10% penalty, and you don't have to be concerned with your level of income impacting your IRMAA surcharge because it's not going to start getting measured until age 63 right here. So we have this super sweet spot going on in this section. Now, after age 63, this is still the sweet spot. You still have a 10-year sweet spot for Roth conversions before you get into RMD territory. However, we do have to be aware of IRMAA impact because IRMAA is based on the income on your tax return, which can be impacted by Roth conversions as well as by RMDs. So the 10-year sweet spot is going to start right here at age 63. Medicare is going to start here for most people at age 65. So we're dividing up the 13.5 years into a 3.5-year super sweet spot and then a 10-year sweet spot from age 63 to age 73. So with that in mind, let's jump into the examples, and we're going to start simple and then we're going to layer on complication after complication. All right, let's pick up where we left off regarding ordinary income and capital gain. If you watched part 3 of this video series, then you recall the blue and the green buckets. The blue bucket represented capital gain, which is this bucket right here, and the green bucket represented ordinary income. We're going to start this video by layering on some more buckets. The first one is going to be the orange bucket, which I'm going to put right here. This is IRMAA. This stands for Income Related Monthly Adjustment Amount, which is an increase to your Medicare Part B and Part D standard monthly premiums. So we're going to put that bucket on the top of the capital gain bucket and on top of the ordinary income bucket. The other one we're going to look at today is the net investment income tax. We're going to call that the purple bucket, which I'm going to stack up here as well. This is a surcharge of 3.8% on investment income when your overall income gets too big and Uncle Sam wants a little more of the action. So we're going to take a look at these two buckets, starting with the net investment income tax. All right, example number 5, and note that these examples are building on the previous video. So we had stopped at example 4. This is going to start with example number 5. So remember in the last video when your spouse, and we're still going to be working on the 2022 tax year for this example. So remember when your spouse bought stock years ago for $100,000. It was sold this year for $183,350, resulting in a long-term capital gain of $83,350. That's the same fact pattern as we had in the previous video. Well, this time, in addition to what's above, you and your spouse combined have W-2 income of $200,000 and net rental income of $15,000 from a property that's under management by a third-party management company. You also decide to do a $40,000 Roth IRA conversion. Questions for this example are: what is your total tax for 2022? What will your IRMAA surcharge in 2024 be, considering both Medicare Parts B and D? And then what is the true cost of that $40,000 Roth IRA conversion in this fact pattern? So step number 1, what is the first thing we do based on your knowledge from previous videos? The first thing is we're going to calculate taxable income. So we're going to put the information that we just went over right here into a table format. We have W-2 wages of $200,000. We have a Roth conversion of $40,000. We have rental income of $15,000. And we have our long-term capital gain of $83,350, giving us AGI, which is adjusted gross income, of $338,350. We're going to take our standard deduction of $25,900, giving us taxable income of $312,450. So let's throw these numbers into TurboTax, and then we will come back here and we will break it down step by step. All right, so we're here in TurboTax. We have our Mickey Mouse return form 1040 for the 2022 tax year. A lot of you guys saw the data entry for this example in the previous video, so I'm going to spare you the actual data entry part for this portion of the video, and we're going to go straight to the results and just make sure we have the same numbers so we can get to the real nitty-gritty of crunching net investment income tax and our IRMAA surcharges. So here's our $200,000 of W-2 wages. Here's our $40,000 of Roth IRA conversion, IRA distribution taxable amount right there, $40,000. Right here is our capital gain, $83,350, like we said. And then the last item here is the $15,000 of rental income that ultimately comes from Schedule E and then Schedule 1 and ends up here on the face of the tax return right there. So that gives us a grand total AGI of $338,350. There's our standard deduction, leaving us with taxable income of $312,450. Let's just go back here to the work paper, make sure we have that. There's our $312,450. We're back in TurboTax, so I'm going to scroll down here and check out what the tax calculation is. So here's the initial tax calculation of $55,158, but you'll notice down here on line 23 we have another $3,357, and that comes from Schedule 2. Let's go to Schedule 2 and see what that is. I'm going to scroll down here, and that is going to be on line 12, our net investment income tax, $3,357. So let's go back to the 1040. All right, so if we take the $55,158 and we add the net investment income tax of $3,357, we're going to have a total tax of $58,515 in this example. All right, we're back in the work paper. So TurboTax calculated $55,158 of regular tax plus another $3,357 of net investment income tax for a total tax of $58,515. Here is the question for you. Is the Roth IRA conversion, which was $40,000, being subject to the extra 3.8% net investment income tax? I'm hearing some yeses. I'm hearing some no's. I'm hearing a bunch of, well, here's the answer. No. The answer is no. Roth IRA conversion is not investment income. Only investment income is subject to the net investment income tax. Roth IRA conversion is not investment income. We're going to talk a little bit more about that in a second. But for now, it is not investment income. Only investment income is subject to the net investment income tax. So step 2. Let's continue by classifying these various kinds of income that we have into various buckets. All right, step 2, classification. So taxable income, we already went over above. That includes everything, and it got down to the $312,450. Now, the regular brackets, the ordinary income brackets for ordinary income items, what goes in there of all the stuff that we're working with in this example? What goes in here? Well, W-2 wages goes into the ordinary income bucket. That's $200,000. Roth conversion income goes into the ordinary income bucket subject to ordinary income tax rates. That is $40,000. Rental income goes into the ordinary income bucket subject to the ordinary income tax rates. Long-term capital gain does not. Long-term capital gain is not ordinary income. Long-term capital gain goes into the capital gain bucket, like we talked about several times over the last few videos. So this is subject to the long-term capital gain brackets, this 83,350. But as we know, these brackets, these buckets are stacked on top of each other. So ordinary income does have an impact on capital gain, and we're going to go through all the bucket examples in just a moment. But capital gain goes in this bucket. And then finally, what goes in the 3.8% surtax bucket, the net investment income tax? And that is investment income. And in this example, we have two kinds of investment income. We have rental income, which is $15,000, and we have long-term capital gain, which is the $83,350. Now, you may be like, wait a second, rental income is in two buckets. It's in this bucket and it's in this bucket over here. And that's right. This is subject to ordinary income tax, just like any ordinary income item would be. But rental income is also investment income in most cases. And what I mean by that is most people who are renting property, like if you're renting a second home or another piece of property to somebody else, chances are it is being treated as investment income to you. The only time that it wouldn't be investment income is when you are actually in the business of renting property. And most people are not. There are thresholds that will identify whether you're actually in the business of doing that. If you're in the business of doing it, it would be business income. It would be like Schedule C income. If you know what a Schedule C is, we're going to get into that in future videos, maybe even a little bit today. It could also be like income from an actual partnership or corporation that you could be a shareholder or a partner in. That may be in the business of renting property. These large conglomerates that have dozens and dozens of apartment complexes that they rent. Those groups are in the business of renting property, and so it would be business income, not rental income. But your average Joe and Jane who are renting a spare home or a couple of properties to people, that's going to be investment income, and that's going to go into the net investment income tax bucket as well, potentially subject, we're going to see how that works in a second, potentially subject to the 3.8% surtax. And just so nobody's confused, when I say potentially subject, it's in this bucket, but this bucket will only be taxed if the amount of income you have goes over a certain amount, which is $250,000 married filing joint. We're going to get into that in just a second here. So this is how you divide up the buckets between ordinary income, capital gain, and investment income. This is very important to understand which items go in which buckets. All right, now it's time to start calculating the tax on the various buckets. So let's start with bucket number 1, which is the ordinary income bucket. You know how to calculate the tax on that based on previous videos. So the first $20,550 goes into the 10% bracket. The next $63,000 goes into the 12% bracket. The next $94,600 goes into the 22% bracket. And then finally, the last $50,951 goes into the 24% bracket, giving us a total of $229,100, which is this number right here. This is the total amount of ordinary income, the $229,100. That is the total amount that's being divided up between the various brackets. And so the question is, what is the cost of the IRA conversion in this bucket, in this ordinary income bucket? What is the cost of doing the IRA conversion? Because that's what we're trying to figure out, is what is the cost now versus what is the cost in the future? What bracket is it being converted in? What is my bracket now versus what I expect my bracket to be in the future? So the answer is that it's 40,000 times 24% equals $9,600. The Roth conversion income is being taxed entirely in the 24% bracket. And how do we know that? Well, if we look at this bracket right here, we can see that there's, of the $229,100, $50,950 is in the 24% bracket. Well, the Roth conversion is only $40,000. So if the Roth conversion didn't exist at all, you'd still be in this bracket by, let's see, 50,950 minus 40,000. So you'd still be in there by like 10,950, right? You're already in this bracket based on your ordinary income and your rental income, less your standard deduction. You're already in the 24% bracket. So the Roth conversion it's not being taxed in partially in the 22 and partially in the 24. If the Roth conversion wasn't there at all, you'd still be creeping into the 24% bracket. So the way that I look at it is the Roth is stacked on top of the other ordinary income items. Your wages you're going to get no matter what. Your rental income you're going to get no matter what. Your standard deduction you're going to get no matter what. You are still in the 24% bracket. So the cost in this portion of the calculation, the cost of the Roth IRA conversion is 40,000 times 24% is $9,600. Also, let's note that the tax on the ordinary income in total for this portion of the tax calculation is $42,665. Okay, so we're going to accumulate the various portions of tax together to make sure that we agree to TurboTax. So before we go on, let's just make sure everybody's following. We're all on the same page here. We just handled this bucket right here. This is the ordinary income bucket. We just calculated the ordinary income tax. So we calculated the tax on this $229,100. We handled this bucket right here, and we determined that specifically related to the Roth conversion, the cost of the Roth conversion in this bucket was $9,600. Now we're going to handle the next bucket, the capital gain bucket. So let's go down to the capital gain calculation. Here it is right here. We have, let's go back up, we have $83,350, remember, in the capital gain bucket. So here's the capital gain, 15% tax rate, $12,503 of tax. Now, what is the cost of the Roth IRA conversion with respect to the capital gain bucket? And the answer is 0. And I want you to think back, why is it 0? Did the Roth IRA conversion impact the capital gain calculation at all? That's the question. Did it impact it at all? What would the Roth IRA conversion have to do in order to be considered impacting the capital gain calc? Well, it would have to push it from one bracket to another. It would have to push some or all of the capital gain from this bucket into this bucket, or from this bucket into the top bucket. So the question is, to answer the question, what is the cost of the Roth IRA conversion in this bucket? The Roth IRA conversion has to have some kind of impact on this tax calculation for capital gain. Otherwise, it didn't do anything. Okay? So if we go back up to the ordinary income, do we have ordinary income that is in excess of that first capital gain bracket, the $83,350? Do we have ordinary income already more than this before considering the Roth conversion? And the answer is yeah. We have $200,000 of wages. That's enough right there. But we also have $15,000 of rental income. So between the wages and the rental income, even considering the standard deduction, we already have enough income to be above this anyway. And we're well below this. We're well below $517,200, but we're above $83,350. That means that the Roth conversion didn't actually impact the long-term gain calculation. There was no additional tax with respect to the long-term capital gain bucket. There was no additional tax caused by the Roth conversion, since all of the capital gain was already in the 15% bucket anyway. Because the $200,000 of wages and $15,000 of rental income already exceeded the top of the 0% capital gain bracket, which is this, that's why. So the capital gain was already being taxed at 15%. The incremental $40,000 of income from the Roth conversion did not push the capital gain bracket up into any higher brackets. It didn't push it up into here, and it didn't push it out of here into here. You were already in here. So when you look at it that way, when you're thinking about what is the cost of doing my Roth conversion, go back to the ordinary income tax bucket. We know there's a cost here. There's always going to be a cost here somewhere in one of these brackets, because Roth conversion is ordinary income and there's going to be tax on it. We know that. The question is, which bracket is it going to be taxed in? In this case, the cost was all in the 24% bracket. Here, there's no cost to doing the Roth conversion under this set of circumstances because of the wages and the rental income. Your capital gain is already in the 15% bracket. So there's no incremental cost of doing the Roth conversion. Okay? If there had been no wages and if there had been no rental income, this is what we saw in the previous video, then the Roth conversion has the effect of pushing some of the capital gain out of 0 and into 15. But if you're already in 15 completely, then and you're not anywhere near getting into the 20%, you're like just in this large bracket of 15, then there's no incremental cost in this bucket to doing the Roth conversion. Okay, now let's get tricky. So here's the tax buckets chart again, just so I don't have to keep scrolling up further on the sheet to show it to you. So this is the exact same chart that we have been looking at this entire time. Now let's go down here to the net investment income tax calculation. So here's how it works. First, you take your investment income, which we know to be $98,350 right here. Then we take our non-investment income that is in the ordinary income bucket. So if we go to the ordinary income bucket, which items are in the ordinary income bucket but not in the investment income bucket? And there's two of them. This one, the wages, and this one right here, the Roth conversion. Those are the two items that are in the ordinary income bucket but not in the investment income bucket. And I'm going to put those two right here. So that's $240,000 total. The threshold to pay net investment income tax is $250,000 married filing joint. So what I do now, after I take the ordinary income items, which is wages plus Roth conversion totaling $240, after I take those, I go back over here to my investment income. I take out of that whatever amount is necessary, in this case the amount is $10,000, to make this number right here reach $250. So one more time, I have $200,000 wages. I have $40,000 Roth conversion. That's $240 total. Here's my $240. In order to get to $250, I need $10,000 more. So I put $10,000 here, and I take it away from this investment income. Okay, this amount is not going to be subject to the net investment income tax. Whatever's left from here will be. So whatever's left is $98,350 minus 10 is $88,350. The net investment income tax rate is 3.8%. So the net investment income tax total for this calculation is $3,357. Now, here's my question for you. We see that the Roth conversion, $40,000, is included over here. I told you earlier that Roth conversion income is not investment income, and therefore it is not subject to net investment income tax. So what is the cost of the Roth IRA conversion in this bucket? Because there is a cost. That doesn't mean this is subject to net investment income tax, but there is a cost here. Let's go back to the buckets again. Before we can really answer this, we have to look at the buckets one more time. Let's break it down using the buckets. So right here, in this first ordinary income bucket, let's just say I only had the W-2 wages and the rental income. All right, let's see right here. So that's $200,000 plus $15,000. Let's just pretend I only have that and I don't have any Roth conversion yet. Stacked on top of that is the $83,350 of capital gain. Okay, the net investment income tax threshold is $250. That means any investment income which is pushed above this amount right here is going to be subject to the net investment income tax. So without considering the Roth conversion at all, only the wages and the rental here, only the capital gain here. The total of this $215 plus the $83,350 gets you to $298,350. That is the total right there. And you can see that a certain portion of that exceeds the net investment income tax threshold. So how much investment income is above the $250 net investment income tax threshold before considering the Roth IRA conversion? And the answer is we have $298,350, right? Here's the $298,350 minus the $250 threshold. $298,350 minus the $250 threshold equals $48,350 multiplied by the 3.8% net investment income tax rate is $1,837 of net investment income tax. There was $1,837 of net investment income tax already before the Roth conversion is considered. So if we look back up here one more time, the total calculation got us to $3,357 of net investment income tax. But if we don't consider the Roth conversion yet, then we have $1,837 of net investment income tax. So the Roth conversion, while not subject to net investment income tax itself, it's still going to be put in this ordinary income bucket, just like before. So let's go down here. Now I'm going to include the Roth conversion income in here. Before we had the $215, there's $40,000 of Roth conversion, so I'm now going to include it. Now I have $245,000 in this bucket. And this bucket is pushing up the capital gain bucket. Let's also remember that $15,000 of this is rental income, also subject to net investment income tax. So now the total $245 plus $83,350, that's $238,350. That is how high we have gone right here. More has been pushed over the net investment income tax threshold of $250. So the Roth conversion itself was not subject to net investment income tax. The Roth conversion caused $40,000 more of investment income to be pushed up beyond the net investment income tax threshold, resulting in additional net investment income tax of $1,520. Okay? So if you hear someone tell you that Roth conversion income is subject to net investment income tax, that is wrong. Roth conversion income is not investment income. And that may seem really weird because inside a traditional IRA, there are investments in stocks, in bonds, in mutual funds, etc. But the traditional IRA changes the character of the income. So when it comes out of the traditional IRA, whether through regular distributions or Roth conversions or RMDs, it is not investment income and it is not subject to net investment income tax. What happens in an IRA is kind of like Vegas. What happens in Vegas stays in Vegas. What happens inside of an IRA stays inside of an IRA. You can buy, sell, and trade securities all day long inside of IRAs. There's no capital gain. There's no interest income annually, paying tax on interest income. There's no paying tax on dividends annually. Everything stays in the IRA. But when it comes out of the IRA vehicle, it is ordinary income, subject to ordinary income tax rates, not subject to net investment income tax. However, as you just saw, because it's in the ordinary income bucket, it can cause other investment income to be pushed up above the net investment income tax threshold. If there was no net investment income tax involved in this situation, there would be no net investment income tax regardless of the amount of Roth conversion or RMD. But in the cases where where investment income is part of the situation, you have to consider incremental net investment income tax as a cost of doing Roth conversions or taking RMDs. So, by the way, here are the three components of the tax we just calculated. We had the ordinary income tax of $42,665. We had the capital gain tax of $12,503. We had the net investment income tax of $3,357, giving us total tax of $58,515. Let's double check TurboTax to make sure that we got the same answer. Here we are, and there is the $58,515. Now, what was the other question that we asked as part of example number 5? And it is, what will your IRMAA surcharge in 2024 be, considering both Medicare Parts B and D, and also how is it impacted by the Roth conversion? Let's get into it. All right, example number 6. Here are the IRMAA brackets for 2024. And the first thing to notice is that your rate in 2024 is based on your 2022 taxes, like we mentioned earlier. So here's the 2024 table, and it's based on your 2022 MAGI. I just want you to think of this as AGI, adjusted gross income. It comes right off your tax return. I'll show you what the modifications to get to MAGI are in just a little bit. For now, this is basically AGI, but it's based on your AGI from 2 years ago. So let's go down to our tax table here, this taxable income that we've been working with. This is the exact same table that we just did in the previous example, calculating the net investment income tax. But for now, I want you to focus on AGI right here. Here's the adjusted gross income, which in our case is $338,350. Let me go to TurboTax. Here we are in TurboTax. AGI is a line. It will always be on your tax return right here. adjusted gross income, 338, 350. All right, so if this is our AGI 338, 350, what IRMAA bracket are we in? Let's go up to the table right here. 338, 350 is going to land us in this bracket right here. This is 1, 2, 3, the fourth bracket down. That makes our surcharge per month, per person for Part B, $454.20, and Part D, $53.80. That's the IRMAA bracket that we landed. Okay, so just to recap, being in this bracket, being in this with this AGI right here of the 338, 350, it makes our IRMAA surcharge equal to $454.20 per person per month for Medicare Part B and $53.80 per person per month for Medicare Part D. That is a total of the $454.20 plus $53.80 is $508 per person per month. But now, here's what I want you to see. Let's wait a second here. Before we did the Roth IRA conversion, what was our total AGI? Let's look at our calculation again, but this time I want to do it with the Roth conversion. This is the one we were just looking at. There's our 338, 350. I want to do it with the Roth conversion, and I want to do it without the Roth conversion because we want to identify what is the impact of the Roth conversion on our IRMAA rates. So this is identical to what we've been looking at. The only difference on this side is that I have taken out the Roth conversion of $40,000. So here's what we got. Originally, we had AGI with the Roth conversion, 338, 350. But without the Roth conversion, we're at 298, 350. Okay, so what bucket does that put us in? We're at 298, 350 now. It puts us in the third bucket right here. Okay, the third bucket, which makes our IRMAA surcharge the $349.40 per person per month, plus the $33.30 right here. That's $382.70 per person per month. Okay, that is a difference of, remember up here, we had 508, right? Let's go back up real quick. Where were we with the 508? Right here. With the Roth conversion, we're at 508 per person per month. Down here, we are at 382.70 per person per month. So 508 minus the 382.70 is an extra 125.30 per person per month. Okay, if you take that 125.30 times 2 people times 12 months, it's $3,000. $3,000 for the year. Okay, a $3,000 increase in IRMAA surcharge for both people for the year. And what caused that increased surcharge? The Roth conversion. The Roth conversion pushed up the IRMAA income into the next IRMAA bracket. We were in this bracket before the Roth, and the Roth income pushed us into the next highest bracket. Or if this is happening in RMD territory, the RMD can cause the exact same thing. Any additional income, ordinary income, goes into your AGI, and your AGI is what's going to push you potentially up into the different brackets. That is why we are building out the personal tax planning template, so that we can smooth out the impact of Roth conversions and RMDs, and to try to minimize the impact not only on income taxes, but all around, including on the effect on our IRMAA bracket. Now, let's talk about an extremely important difference between ordinary income and capital gain brackets versus IRMAA brackets. All right, there's a very important difference I want you to understand when you're doing Roth IRA conversion planning, and that difference is the difference between ordinary income brackets, capital gain brackets, the net investment income tax threshold versus IRMAA brackets. IRMAA brackets are cliff brackets, whereas these other three right here, these other three are not cliff brackets. What does a cliff bracket mean? Well, let me ask you a question. When someone walks off a cliff, can they kind of walk off a cliff? Or is it really more of an all or nothing arrangement? And the answer is it's an all or nothing arrangement. You can't sort of walk off a cliff. And that is the difference between IRMAA brackets and the tax brackets. Okay? Let's go down here and look at the difference. With the income tax brackets, as well as the capital gain brackets, as well as the net investment income tax, if you are trying to max out your 24% bracket, for example, with a Roth conversion, okay, this would be the 24% bracket right here. So let's say this is the 2024 rates. Let's say that you were trying to max out this bracket. So you were trying to push your income up to $383,900 in order to take advantage of the 24% rate in 2024. Maybe you believe the law is going to change, or your income is going to go up, or some combination of both. Tax Cuts and Jobs Act might expire. Congress might be a mixed Congress. Maybe they won't change the law. Maybe they won't make it permanent. It's going to expire automatically. Who knows? There could be all kinds of reasons why people are trying to max out the 24% bracket in 2023, 2024, and 2025. I know a lot of people who are, because people are uncertain what's going to happen when the Tax Cuts and Jobs Act expires, and all Congress has to do is nothing, and it will expire. So let's say you're trying to max this out. You're trying to get your income up to $383,900, and you mistakenly push $1 into the 32% bracket. You push the dollar over this threshold, over $383,900, and you push it in here. What happens? Well, with the income tax brackets, only that single dollar will be taxed at the 32%. All right? It's not like by pushing the dollar over, you risk everything else. You're only risking $1 essentially. So you can be kind of aggressive. If you want to max out this bracket, you can be aggressive in trying to reach this, the top of this bracket here, because if you mistakenly, you don't calculate perfectly and you push $1 or $2 in here, it's only that $1 or $2 that gets taxed in the next bracket. The rest of the income will remain in the 24% bracket or lower. That is not a cliff. Okay? Now, but with IRMAA brackets, the minute you push just $1 of income into the next bracket, that's it. You're in. You're in that bracket. Your Medicare surcharge will be completely in that bracket. You've gone over the cliff, basically. Okay? So if you're in, let's say you're in this third tier right here. You have $322,000 of income. You're right at this number. The minute you push $1 into the next IRMAA bracket, that's it. You are now, your IRMAA surcharge is now this. Your IRMAA surcharge for Part D is now this. It's not like only that dollar is impacted. Your entire surcharge is impacted. It's not like you only kind of pay some of this because you only pushed a little bit over the threshold. No, that's a cliff. That's what a cliff bracket means. So just to recap again, you push $1 higher in ordinary income tax brackets, in capital gain tax brackets, you push $1 over the NITT threshold, only that dollar is affected by the next bracket. But with IRMAA brackets, it's a cliff. So with IRMAA brackets, you have to be a little bit more careful. So when we're doing Roth conversion planning or RMD planning, my position is that it's perfectly fine to be aggressive with maxing out an income tax bracket, with trying to maximize your income tax bracket. Because who cares if you mess up and accidentally push a few dollars into the next bracket? It's only going to be those few dollars that you messed up and pushed into the next bracket that will be impacted. You pay 32% on a few dollars, who cares? But when you're considering the impacts of IRMAA, we need to be more conservative, or at a minimum, we need to at least be aware that if we're too aggressive with maxing out a bracket, we might mistakenly go over the cliff with respect to IRMAA and be stuck with those higher surcharges. Now, a lot of people will say, well, you can just think of IRMAA as an additional tax. Like in the previous example, we moved up a bracket and we were subject to $3,000 more IRMAA surcharge, and you can absolutely think of that just as part of the tax, part of the cost of doing Roth IRA conversions, et cetera, and that's fine, but you need to at least be aware of it. And if you're okay with paying that additional surcharge to get a large amount of Roth IRA converted, there's nothing wrong with that. As I've said many times, there's no right or wrong. It's only right or wrong with respect to your situation. But you can, without realizing it, try to max out a bracket for income tax purposes, or maybe not even max it out completely, and then suddenly you've accidentally crossed the threshold for IRMAA when you didn't mean to. And how do we keep all this stuff straight? How do we get it all figured out? And the answer to that is that's why we need an IRMAA calculator incorporated into our personal tax planning template. So let's go take a look at that. All right, so here we are inside of the personal tax planning template. I've got a lot of updates incorporated into this, but the one I want to really focus on now is the IRMAA calculator. So here it is. This is going to help us figure out what our IRMAA impact is as we do our Roth IRA conversion. So let's just go down the list here and see what's going on. So the first thing is the Medicare premium year. So that's going to be the year that you're working on. So like, for example, we'd be working on 2025, projecting for 2026, 2027, and so on. Now, the relevant tax year for MAGI purposes, as I mentioned, is 2 years prior. So for example, if we're planning for 2025, we're going to be looking at 2023 MAGI. If we're planning for 2026, we'll be looking at 2024 MAGI and so forth. So I'm going to come back to these three lines right here in a moment, but let's just go right to this. This is our projected AGI from the tax planning template. So I'm going to do 2025 as an example, because remember, you have to look back 2 years to 2023. So what our IRMAA rates will be in 2025 is going to be based on what we're doing right now in 2023, and also what we're going to be doing shortly in 2024 is going to impact 2026. Okay, so if I go to this AGI number right here, this 404,468, if I go to my tax planning template and I look at 2023 and I go down to AGI, there's my 404,468. Because remember, what I'm planning for in 2023 is going to impact my IRMAA rate in 2025. For 2022, I'm just going to have it be a static number because, for 2024, I'm going to have it be a static number because the template is starting in 2023. If you want to incorporate another column for 2022 in here with your actuals, you certainly can do that. My suggestion simply would be to go to your 2022 tax return, grab your AGI, and just type it in right there to help you figure out your impacts for 2024. So we have AGI. Now remember how I was talking about MAGI and how you have to modify your AGI for a couple of things for purposes of the IRMAA calculations? Well, let's go through that right now. These are the two things that you have to modify it for. The first thing is going to be tax-exempt interest. That would be like interest on municipal bonds, interest on state and local government bonds, stuff like that. If you have that, let me show you where that is in TurboTax. So here's the 1040. If you have tax-exempt interest, it's going to be listed right here on line 2A on the front page of the 1040. Tax-exempt interest, you would have a number right here. And so if you have this, then you can be aware that you have tax-exempt interest, which you need to make a modification for purposes of calculating IRMAA. All right, so if you do have tax-exempt interest, you would just drop it in right here as a positive number. Let's say your investment advisor has you in muni bonds or whatever. If it's, pretty consistent over the years, you can just project it out. I think I'll get about $5,000 a year and so forth if you are invested in those kinds of instruments. If you don't have tax exempt interest and you're not invested in anything like that, you can just leave these as zero. So that's the first modification. The second modification, I have a whole list of stuff here, but it's really unusual stuff that probably doesn't apply to that many people, like income from Puerto Rico, American Samoa, earned income of U.S. citizens living abroad excluded from your gross income. It'll apply to some people, but for the most part, the stuff on this list won't apply. So you can look at that list. If there's anything that really applies to you, you can put that in on this line. Both of these items will increase your AGI to arrive at the MAGI that they want for purposes of calculating your IRMAA surcharge. But like I said, I would think for most people, these two rows will end up just being blank, and that's why I said earlier, usually you can just think of your AGI and your MAGI as basically the same thing. All right, let's keep going down the tracker here. Here is what I want to show you next. Let's start down here in this orange colored section. So right here, these are the actual IRMAA brackets for 2024 that we looked at in the previous examples. These have been published as of the making of this video. These have been published by the Social Security Administration. So these are the brackets, and then this is the Part B surcharge, and down here is the Part D surcharge. So these are actuals because they've been published already. Now, they only publish them, getting close to the end of the year. So for any year after 2024, we're going to kind of have to project out what we think the brackets and the surcharges are going to look like, because there's no way to know what they are until they're actually published by the Social Security Administration. So for 2024, we know what they are. For 2025, what I've done here is I've put in 3 rows, one for the bracket, one for the Part D surcharge, and one for the Part B, and then one for the Part D surcharge. And you can keep them all the same. You can do them individually if you want. The point here is the brackets historically grow by about 4 to 8% for inflation year over year. So when we're doing projections and you're like, I really don't want to, go over that cliff. I don't want to end up in the wrong bracket. If I'm in this bracket, I don't want to go into this bracket. If I'm in this bracket, I don't want to go into that bracket. And so what we can do is we could put in kind of a conservative growth rate here. So for example, let's say this is the actual for 2024. I have a 3% growth rate going on right here. So this number of 331,660, this is growing this amount by 3%. If you want to be even more conservative, you can change this to, I think 2% is really what it's, I don't want to accidentally go over the cliff. If you want to be more aggressive, you could change it to 5%. You can change it to whatever you want. You can change these individually by year and so forth. I would say if you're being conservative, you want to be about 3% is probably reasonable. But these rows are here. Let's say the inflation takes off or it slows down. The government starts changing what they're doing. Social Security starts changing what they're doing. You can adjust your projections here. But then each year, as the actuals are published by the Social Security Administration, you would want to just update these for the actual number and then project forward into the future from there. So with the brackets and the surcharges in mind, here's what happens next. The calculator will look at your MAGI. Let's do 2025. The calculator will look at your MAGI, and that's your MAGI for 2023. And it will then go down in the list here, and it will say, okay, where am I in the list? I'm above this number, so I'm in this bracket right here. I'm in the 5th bracket with this amount of MAGI, which means if I go a little bit further down, it means my surcharge is going to be 575 plus 76 for a grand total, which gets summed up here in the yellow section of 652. That's the 575 plus the 76. 652. That is the monthly surcharge for one person, surcharge per person per month. Then I have an annualized number per person. I have the monthly surcharge for two people if you're doing married filing joint, and or if you're married, I should say, so you want to know what your surcharge is for two people, and then an annualized number. So for example, if this was a couple, this couple would have a $15,652 surcharge in 2025 for the year for two people, based on this amount of income right here. Now, the last thing I want to focus on is this line right here in red. This line is what I think is the most valuable analysis portion of this entire calculator. And what it does is it looks at your projected AGI, which, remember, this comes off of our main tax planning template where we're doing our Roth conversion analysis and our RMD analysis and all that. This gets pulled off of there, and then this calculator checks this number against the brackets, and it says, how much do I need to get into the next lower bracket? Or in other words, how much lower does my MAGI need to be to get from this bracket into this bracket? And in this case, we are over by $6,888, meaning if I can just lower this by $6,888, instead of being in bracket 5, I can move down to bracket 4 and lower my surcharge in 2025. This is all part of the planning process. So with that in mind, I'm going to go back and say, wait a second, what are we doing in 2023 that's causing us to creep over this threshold and end up in the next bracket? So when I go back here to the personal tax planning template main page, I'm going to go to 2023, which is right here, and I'm going to look down here like, what are we doing? What are we doing on here? Well, we have $100,000 of wages. We can't really control that. Interest income is $4,000. We have our ordinary dividends. Let's say one of the spouses is collecting a pension. Maybe they retired early or something happened. Whatever it is. But here's the real crux of the issue. We have a planned Roth conversion for this year of $195,000. And maybe that made a lot of sense considering all these other things that we have going on. But it may not make sense for purposes of IRMAA, because what that's doing is it's causing us to be $6,888 over the threshold of the fifth bracket. We want to get back into the fourth bracket. So how about I go lower my Roth conversion? Let's say, just to be conservative, I'm going to lower it by $10,000. So I go here, instead of 195, I'm just going to go ahead and convert 185 for 2023. My guess, let's see what happens. I do the 185. We go back to the IRMAA calculator, and we look here at our total annual surcharge for two people. It's $12,577. Okay, what was it before? If I go back here and I change this back to 190, actually it was 195, wasn't it? Change it back to 195. Go back to the IRMAA calculator. 15.6. Let's undo what we did a second ago. Put it back to 185 and go back to the IRMAA calculator. 12.5. So again, another like $3,000 in savings on your IRMAA surcharge in 2025 based on proper Roth conversion planning in 2023. And here's the thing. Like I said, a lot of people will say, IRMAA is just another tax. You're just paying another $3,000 in tax to do part of that Roth conversion. But it's like, really, I'm going to do just another $10,000 in Roth conversion, and I'm going to be hit with another $3,000 in IRMAA surcharge? My guess is, when you're considering your own facts and circumstances and your own cash flow situation, I bet you'll hardly ever notice the difference between $185,000 and $195,000 Roth conversion. But what you may notice a difference is an extra $3,000, out of your pocket, essentially, in 2025 because your IRMAA surcharge is higher. And so again, it's not right and wrong. It's not that one is right or one is wrong. It's what is right or wrong for your situation. But how are you ever going to know unless you lay it out with the numbers and figure out what is the most optimized strategy? What is the most optimized Roth conversion that I can do, not only to max my bracket out for income tax purposes or get high enough in the brackets where I want to be based on my situation, but also taking into account other impacts like IRMAA. So again, when we changed it, now we've gone down a bracket, and now it says, all right, you need to drop another $62,000 to get even lower in the brackets. And that may not be realistic. Maybe you really want to do that Roth conversion. You're willing to stay, and you're not in the 5th bracket anymore, you're in the 4th bracket, and you're willing to be in the 4th bracket in order to get that Roth conversion done, and you're okay with that. But what you don't want is to convert, a few $1,000s too much and then be hit with that extra IRMAA surcharge because of it. And that's what this calculator really can do to help. By the way, if you are interested in this IRMAA surcharge calculator, it is now part of this entire personal tax planning template workbook, which I do have available for purchase, along with 3 all-new exclusive training videos demonstrating how to use it. That's in addition to the 4 behind-the-scenes videos where I show you how I built the template from scratch. Your purchase helps out the channel, and it gives you a planning and analysis tool that you can use throughout your life to help minimize your taxes and maximize the cash that remains in your family's pocket. So it is a win-win for everybody. If you're interested, you can check that out in the description below this video. And if you are already in the course, you get lifetime access to all updates that I make to the template as we build it out, video by video. So just log into your membership area and you will be able to download the latest version that you see right here. All right, let's switch gears here and talk about some conventional wisdom when it comes to IRAs and brokerage accounts and stuff. These are the kind of conventional wisdom I see all the time. So these are the kinds of investment accounts that people have and typically what they do with them. You got your regular brokerage account. This is where I do my active trading. This is where I do my aggressive strategies. This is where I do my day trading, my swing trading, all of that kind of stuff. On the other hand, in my retirement accounts, this is where I do my long-term holding. This is where I do my conservative strategies and so on. And that's the conventional wisdom, right? This is where you do your long-term investing and get ready for retirement. This is where you do your active, aggressive type of stuff. And people make blanket statements and they have these blanket beliefs about what you do in these different types of quote-unquote tax-advantaged or not tax-advantaged accounts. And we're going to run through some examples here where I'm not convinced that the conventional wisdom is actually the most tax-efficient approach. And I'm going to show you those examples, and I think you're going to find those interesting. But the conventional wisdom is well, active trading in your regular brokerage, that's good. Active trading in your IRAs, that's bad. Conservative investing in your regular brokerage, that's bad. Conservative investing in your IRAs, that's good. And I mean, not everybody's like this, but the point is this is sort of the conventional wisdom of the way that people think about what they're supposed to be doing inside those kinds of accounts. And why do you think that's the conventional wisdom? Why do people think like this? My opinion, one of the main reasons anyway, is that it's kind of something like this. A lot of traditional IRAs out there are rollovers from 401ks at previous jobs. And how do you generally invest inside of an employer-sponsored 401k? Well, pretty much you basically make your decisions one time a year from a limited selection of investment choices, most of which are blended funds or strategies based on your age, maybe with some minor variations in risk profile. And then here's the key. You basically forget about your 401k for the rest of the year. It's managed by someone else. You don't do anything active with it. It's kind of treated as this long-term behind the scenes kind of a thing, right? And then you leave your job and that 401k gets rolled into a traditional IRA. And what tends to stay the same after that happens? Well, people's thought process stays the same. People's thought process about what that account is and about how investing in that IRA should occur. And so a lot of people that I see, without really thinking about it, they just keep their long-term retirement style, non-active investment strategies going on inside the IRA. And a lot of you might be shaking your head like, well, obviously, yeah, that's what you do in IRAs. And yeah, that's the conventional wisdom that that's what you do inside of IRAs. But when we go through the examples, you might draw a different conclusion. And so then they do all of their active and aggressive trading in their regular brokerage accounts. So is that the right thing to do from a tax perspective? Before we get into the examples, let's ask Harry. Of course it's the right thing to do. IRAs are tax advantage retirement accounts. Don't you know anything? Well, okay. Let's see what happens in the examples. Jane, on the other hand, it may be the right thing to do, it may not. Nothing is right or wrong. It's only right or wrong based on your facts and circumstances. And I think I agree with that. So let's crunch some numbers and see if we can figure it out. All right, so stock trader example 1. Here's Harry. We're going to do regular brokerage account and traditional IRA. We're going to active trade the regular brokerage, and we're going to long-term invest in the traditional IRA. So here are the regular brokerage account entry fields, and here are the traditional IRA entry fields. Here's the output fields down here. So we're going to start out with $10,000 opening balance in both the regular brokerage and the traditional IRA. Now, for his active, aggressive trading strategy, we're just going to say that he can get an average annualized return of 25% with active trading, and over here, 5% with long-term investing. Okay, and in both cases, he's going to be in the 24% marginal tax bracket. So the way this is going to work is very simple. Here's the opening balance of $10,000. The annual return on that $10,000 was 25% or $2,500 right here. This $2,500 is actively traded income, meaning it is sold in shorter periods of time than 1 year. So it's subject to his ordinary income tax rates, his marginal tax rates, which in this case is 24%. So 24% of $2,500 is $600 of tax. So the opening balance plus the return minus the annual tax that he's paying on active trading gets you the closing balance of $11,900, which carries to the opening balance of the next year, and so on and so on and so on. That's going to be the example for him doing active trading over a 20-year time horizon, getting an annualized rate of return of 25% on his advanced active strategies, 24% tax rate. At the end of that 20-year time, he's going to have $324,294. So the ending balance in his regular brokerage before tax is $324,294. There is no tax on the way out because all of this is taxed annually. So there's no exit tax on this particular strategy in the regular brokerage account. So the ending balance after tax will also be $324,294. Now in his traditional IRA, he just has $10,000 earning a 5% return. So there's the return. There is no tax annually inside of the IRA. Everything grows inside of the IRA tax-free, so you only pay tax on the way out. So he doesn't pay any tax. He gets $10,500. That carries forward to the next year's return, add it to the closing balance, and so on and so on and so on. After 20 years, this has grown to $26,533, which is right here. the tax on the way out is taxed at his normal 24% marginal tax rate. Remember, this is not investment income. This is not income subject to capital gain. When money comes out of your traditional IRA, it's going to come out at your ordinary income tax rates. And that's something that I really want to focus on right here. We're going to get to that in a few minutes. People say that a regular brokerage account, we're not talking about this example specifically, but people say, well, there's no tax advantage in a regular brokerage account. Actually, a regular brokerage account has the best tax advantage of any account, in that if you just hold for longer than a year, you can get 15%. This is why Warren Buffett says that his effective tax rate is lower than his executive assistant and his employees, because most of his money, he's not in IRAs, most of his money is in regular accounts subject to 15% long-term capital gain. Meanwhile, his executive assistant and all of his employees are running around talking about, how can I get my Roth conversions done at 24% before the Tax Cuts and Jobs Act goes away and I'm going to be in even higher brackets? And why is their money going to get taxed at 24%? Because it's stuck in this vehicle where you think you have a tax advantage, but when it comes out, it's coming out at your marginal rate. So if you're going to hold for more than a year anyway, why would you hold it in something where it's going to come out at your marginal rate when you could hold it in something where it would come out in a 15% rate? We're going to get to that in a few more minutes, but let's focus on this example. So right now, this money at a 5% annual rate of return, this carried forward 5%, et cetera, et cetera. We're up to 26. Exit tax. He took it out of the IRA. Exit tax is the $6,368. So he's left with an ending after-tax balance of $20,165. Grand total after tax return. This number right here plus this number right here, $344,459. That was his return for aggressive trading at 25% in a regular brokerage, and conservative investing at just a 5% return with no active strategies inside of a traditional IRA, $344,000. Now, let's go to example number 2. All right, stock trader example number 2. This time we have Jane. Jane says, I'm not going to follow the conventional wisdom. I'm going to do the opposite. I'm going to do a flipped strategy. So she still has a regular brokerage account and a traditional IRA, but this time we're going to long-term invest the regular brokerage and we're going to active trade the traditional IRA. So the starting points are going to be the same: $10,000 in the regular, $10,000 in the traditional IRA. Now the rates of return are going to be the same, except I'm going to flip them around. We're going to do, here's the 5% on the conservative long-term approach, and here is 25% on the active trading aggressive approach. And Jane is also in the 24% marginal tax bracket, but because she is going to be doing long-term investing in a regular brokerage account, she is only going to be subject to tax when she sells at the end, which in this case will be 15%. So she's not going to be subject to any marginal ordinary income tax rates in this example. All right, so let's just get started. It's exactly the same thing. $10,000 here, 5% rate of return, et cetera, et cetera, et cetera, all the way down 20 years. She's got $26,533 in the regular brokerage. Now she's going to have to pay a long-term capital gain, though, because she's been holding the whole time. So she's got $26,533 before tax. She pays a 15% rate on that long-term capital gain. So she has $22,553 after tax. In the traditional, she starts with her $10,000. She gets a 25% rate of return on her active aggressive strategies. There is no tax inside the traditional, so that just keeps growing and growing and growing. And at the end of 20 years, she has 867, 362, but she does have exit tax. So here's the 867, 362. Here's your exit tax of 24%. The money is going to come out at your marginal rate. She ends up with 659, 195. So when you add these two together, she's at 681, 748 grand total return. Now wait a second. Let's go back to example 1. 344, 459. Everything was basically the same except which vehicle you were doing certain things in. Did I change what stocks, what bonds, what mutual funds, what strategies? Did I change any of that? No. I simply said, put your aggressive stuff in the traditional IRA and do your long-term holding in the regular brokerage account. And just by doing that, the difference in return went from 350 to 680. Just from that, just from active trading the traditional and long-term holding the Roth. So when people say this is a tax-advantaged account and this is not a tax-advantaged account, I don't believe that's completely accurate. This is tax-advantaged in that you can actively trade in it. Well, let me back up. They say this is tax-advantaged, but then they sit there and they hold long-term inside the traditional IRA. Well, it may be tax-advantaged, but you're not taking advantage of that by holding long-term. The advantage is that you can actively trade inside the IRA and not get hit with short-term tax rates, with your marginal tax rate, your ordinary tax rate, not get hit with that every year. That's the tax advantage, not that you just let the money sit there. If all you do is let the money sit there, you may as well just let it sit there over here, because it's still going to, whether you let it sit there or not, it's going to come out at 24% or whatever your marginal rate is. If you're going to do long-term holding, do it in here where it's going to come out at 15%. And that's the thing that I think a lot of people don't fully comprehend is, yeah, this is tax advantaged, but it's only tax advantaged if you're actively doing something in here. That's where the tax advantage is. It's that you don't get taxed every year on your active strategies. If you're just holding long term, your money is coming out at your marginal rate. It's not coming out at what is really the largest, one of the most highly tax advantaged accounts, which is just a regular brokerage account as long as you hold it for a year. So simply by flipping the long-term strategy into the regular brokerage and the aggressive strategy into the traditional, the difference in return over this 20-year period is substantial. And there was a question on the channel that said, can you trade inside of IRAs? And the answer is, yeah, you can. I do. You can trade inside of IRAs and Roth IRAs. What'll happen is you just have to meet some minimum account requirements. We're getting a little off topic here, but you just have to meet some basic like day trading account requirements, which I think is $25,000 account balance. And there may be some other requirement that I can't remember, but they're not hard to meet. And then all you do, I believe, is you make like 4 round-trip trades. So you buy and sell the same security on the same day 4 times, and they will identify you as what's called a pattern day trader. And you will get a letter in the snail mail probably that will say, hey, we've identified you as a pattern day trader. Here's the requirements. And you just follow those. And yeah, you can trade inside of IRAs just like you can trade inside of a regular brokerage. So when you say it's tax advantaged, you really have to think about what that means. It's tax advantaged if you're actively doing something and not getting hit with tax every year. But if all you do is hold and do your long-term investing inside of this, you're doing yourself a disservice in many cases, because you could have just done it over here and walked out at 15% instead of having your exit tax be 24% or whatever your marginal rate is. So that's something to think about. And it's not blanket statements. It's not this is good and that's good. It's sit down here and crunch the numbers for yourself and see, and you'll see that you may be thinking about it not exactly in the right way. Let's go to stock trader example 3. This time we're going to have Whiz Kid Billy. His mom gave him $10,000 to invest in a regular brokerage account, and $10,000 he's got inside of an IRA. But here's what he's going to do. We're going to have a regular brokerage, we're going to have a traditional IRA, and then we're going to start doing Roth conversions. So what Billy's going to do is long-term invest the regular brokerage. He's going to active trade the traditional IRA, and then he's going to do an annual Roth conversion and then active trade the Roth. There's not going to be any money coming in from the outside. We're starting with the $10,000 here. We're starting with the $10,000 here. That's the only source of money other than return, rather than rate of return. We're not going to infuse other cash. Okay, so it's going to start 10,000, 10,000 like we said. This is just like the example with Jane. 5% rate of return on long-term investing. 25% rate of return on active trading. We're just going to say Billy's in the 24% tax rate to keep everything equivalent. 15% on long-term capital gain. So here's what he's going to do. He's going to start with the $10,000 in his regular brokerage. He's going to get his 5% rate of return, and he is going to wait exactly 1 year. And as soon as that 1 year mark passes, he's going to sell this position and he's going to pay tax on this gain, and that will be at the long-term capital gain rate since he waited 1 year. So the long-term capital gain rate of 15% on 500 is $75. So he takes the 500, he pays $75 on it, leaving $425. And he says, with this $425, I am going to pay tax on a Roth conversion. So how much Roth conversion can he do with $425 available to pay the tax? Well, that's a simple calculation. You just divide the amount of money you have available to pay the tax by your marginal tax rate, and it will tell you how much you have available or how much Roth conversion you can do. So he can do $1,771 of Roth conversion and pay the tax using this money right here. So in the regular brokerage, he's going to do this each year. He's going to get his 5% rate of return. He's going to wait exactly 1 year. He's going to sell it and pay the long-term capital gain tax, and he's going to take the rest of the gain out of the account and use it to pay the tax on a Roth conversion. And so when he pays the tax and takes the rest of the money out, he still has a closing balance of 10. And he does that over and over and over each year. And at the end of the 20 years, he still has 10 because every year he did exactly the same thing, paid the tax, did a Roth conversion. So he's at 10. His output from this account is 10. There's no tax at the end because he already paid the tax each year as he sold. So he's got 10. So over the 20 years, there was the return that occurred in here was used to do Roth conversions. Okay. Now, in the traditional IRA, here is his opening balance of 10. He's doing his aggressive strategy, so he's getting a 25% rate of return, so that's $2,500. There's no tax, right? Just like we talked about in the previous example, but he's going to choose to do a Roth conversion, and the money is going to come out of this account. Okay, it started with the 10. It gets a rate of return. He's going to pull out a certain amount each year, and he's going to use the money from the regular brokerage, that extra part of the gain, to pay that tax. And so he's going to do a $1,771 Roth conversion each year. And so here's the opening balance. Here's the return. He takes out this much money for purposes of the Roth, and there is his closing balance. Goes to the beginning balance, and that just happens over and over and over and over again. At the end of 20 years, he's got $260,064 right here, but there is an exit tax. That exit tax is 24%. So he has $197,649. Now, let's go over here to the Roth. So here's the Roth. The Roth, I'm going to start in year one with no balance. In fact, there's going to be no activity in year one at all. The reason I'm doing that is because I don't want any other money infused into this example. I only want the money in the Roth to come out of the traditional. So I'm going to say basically like he basically got this rate of return for the year, and right about the 1 year mark he did that. Or I shouldn't say 1 year mark because he couldn't pull the money out of the regular until 1 year. So at the 1 year mark he does his first Roth conversion, and that Roth conversion becomes the opening balance for year two in the Roth. Follow? So this conversion that happens right at the end of year one becomes the opening balance in year two inside the Roth. Okay? He's doing his aggressive trading, so he gets 25% inside the Roth. There's no tax inside the Roth, and so his closing balance is the conversion plus the return. That carries forward to the opening balance. Then the next year, at the end of year two, he does the exact same conversion, and that gets added to the beginning balance of year three for the Roth. So now here's his opening balance. He does another Roth conversion. He gets his return on the sum of those two. That goes to the closing balance. So the sum of these is going to be your closing balance. That carries forward, and on it goes. He just keeps doing a Roth conversion of a small amount based on the available extra gain that he had in his regular brokerage over here. And in year 20, he has 605, 527. And of course, there's no exit tax on the Roth. So let's just look at year 20 for a minute. So he's got 605, that's this number. He's got the 197 coming out of the traditional after tax. And then he's got that 10,000, which never changed because of the strategy that he's doing. And so just looking at these three numbers right here, he's sitting on 813,176. Whereas Jane, she was at 681,748. And back here, 344,459. This is the same 10,000. This is 10,000 starting here, 10,000 starting here. In all three of these examples, no other money has been infused anywhere else. Okay, this is simply changing which vehicles we're using and what we're doing. So Billy, the whiz kid, by doing this, by waiting that 1 year, paying that long-term capital gain rate, taking the rest of the gain, using it to do a Roth conversion, getting that money over into the Roth each year, doing his aggressive strategy over here, at the end of year 20, he's sitting on 813,176. And the reason I went out one more year is because this account didn't actually start until year two. So you can look at it either way, however, whatever you feel like. Even if we don't bother looking at the 21st year, which would bring his grand total up to 966, we just say, all right, we're going to cut off the analysis at 20 years, and there's really only going to be 19 years of growth in this Roth, but that's okay for purposes of our analysis. Even then, Billy is sitting on 813 versus Jane at 681, okay? Just by doing a more tax-advantaged approach, same strategies. It doesn't matter. He's doing the exact same thing with 25% over here. He's doing the exact same thing with 25% over here. He's getting 5% over here. Jane is doing the same strategy. Everyone's doing the same strategy. Nothing has changed about the stocks, about the bonds, about the mutual funds, about your actual underlying portfolio. The only thing that has changed is what vehicle are you doing things in? And have you figured out the way to get your most tax optimized strategy with these accounts that you have available to you? A lot of people don't think about active trading your IRAs, and yet that is actually where the tax advantage is. Because again, well, in a Roth doesn't get any, once you get the money in, other than 5-year clocks, once you get the money in, this is the best place to have money, really. You want to stuff the Roth, considering everything else that we've talked about, considering your rates, considering everything. If you can stuff the Roth through conversions, this is the best place you could ever have money, because it can grow and be tax-free forever. You can trade until your heart's content in here, and none of those gains will ever be subject to tax. And the only thing that Billy did differently, he started with the same $10,000. He had the same rates of return. He just optimized his tax strategy to get as much as he could into the Roth, considering his limitations on how much he had available to do Roth conversions and everything else. He didn't infuse any other cash, and he still walked out way ahead of the other two because he was the most tax optimized. So when we're talking about optimizing your investment vehicles and your trading strategies, we want to talk about the stock trader calculator, which is coming up next. All right, so we're back in the personal tax planning template, and the next tool that I want to go over is the stock trader calculator right here. So here it is, stock trader calculator. Use this calculator to determine your most tax efficient trading and investing strategy. In this work paper, blue cells are going to be data entry, and then green cells are going to be output. So let's go through it line by line and see what we got. So first off, we have a portfolio account type. I have 3 columns for a regular brokerage account. I have 3 columns for a traditional IRA, and I have 3 columns for Roth IRA. Typically, I see people, usually they have at least 2 or 3 of these, usually 2 or 3 of these. Most people might have like 1 or 2 of these, but I have room for 3, and you can certainly expand this and customize it as you need it. If you need more than these, if you need more than 3 of each, if you don't need to use all 3, you can just put a 0 here in the portfolio value if you don't need to use all of them. But for this example, I'm just going to use all of them. I'm going to come back to the portfolio investment code in just a moment. Let's skip that for the moment. All right, portfolio allocation by dollar amount. So here is where you would type in your account balance for each of these different types of vehicles at the time you want to start this analysis. So I've put in some different account balances right here, and the total of all of these for this example is just going to add up to 500,000 total portfolio value. So here we have our portfolio allocation percentage, just the amount in each one relative to the total. So you can have some idea of, like, when you're figuring out what strategy is occurring in each of the different accounts, you have some idea of like what percentage of your total portfolio that's actually related to. All right, projected return, we're going to come back to that one as well in just a minute, and then the tax rates, we're going to come back to that. Let's go to this table right here. This is where the information that I said we'll come back to is all going to come out of this table. So let's do this table next. All right, so this table is where we link up your trading and investing strategies to appropriate rates of return and applicable tax rates so that we can figure out how to optimize your trading strategies within these various buckets of different kinds of accounts. And by optimizing that, we're trying to get the best after-tax cash result. That's the entire point of this. So what I have right here is I have 5 placeholder investment strategies, starting with our conservative, long-term, held more than a year strategy on the one end, and then our active day trading, swing trading type of strategies on the other end. And then in the middle, we'll have 3 mixed strategies. So this one would be like leans conservative, more long-term stuff in there, but there may be some active activity. Then a middle strategy would be something like half of this, half of this. And then a third strategy would be leans active, but there may be some long-term activity in there. And you can adjust these as you see fit based on the kinds of investing and trading that you do. You don't have to use all 5. You can use whatever is most appropriate for your situation. We're going to assign each one a code. This code can just be made up. It's just used to pull information out of this table. So just put in a code that makes sense to whatever you call your strategy. Okay? Now, projected investment return. In this, we have to figure out, what do you expect based on your historical results, based on what you know how to do in the market, based on your strategies. What is a realistic return that you're going to expect for these different kinds of portfolios or strategies? And you need to assign a rate right here. This rate is for you to figure out for your own facts and circumstances, your own trading and investing portfolios. What are you expecting? What can you realistically expect, or what are you projecting for the future? You have to assign this. Now, in this column, what we're going to do is we're going to figure out how much of this portfolio produces short-term gain, thus being subject to your ordinary income tax rates, not subject to long-term rates. Okay? So these two columns actually go hand in hand. So in my conservative long-term strategy, I'm going to expect 0% of the gain to be subject to my marginal rates because it's all going to be held over a year, and I'm going to expect 100% of it to be subject to long-term capital gain rates. In my middle strategy, I have something like 50-50. 50% of what I do in this strategy will be subject to short-term rates, my short-term ordinary rates, 50% long-term capital gain. And then on the other end of the spectrum, 100% of it is going to be subject to my marginal ordinary income tax rates in active trading, and none of it is going to be subject to long-term capital gain. And you don't have to keep these exactly as they are. You can look at your actual portfolio and figure out, how much of this am I trading, how much of this am I holding, and what are the appropriate percentages that should be in here, so I can figure out how to optimize my portfolios within these different kinds of accounts. All right, then you just type in your marginal tax rate, whatever it is right here, and your long-term tax bracket, which for most people is going to be 15% in most cases. Okay, then what this is going to do over here is it's going to figure out what is your mixed tax rate, basically for short-term and for long-term. So, for example, on this conservative portfolio, my projected short-term tax rate is going to be 0 because none of it is going to be short-term. Okay? On the other hand, my long-term tax rate is going to be 15% since 100% of this portfolio is going to be long-term capital gain, so my projected long-term capital rate is going to be 15%. On the other hand, with active trading, my projected short-term rate on the portfolio itself is going to be 24 because all of this is going to be short-term income. None of it is going to be subject to long-term capital gain. But in the middle, we're going to have some mixed rates. So for example, in mixed strategy number 1, if 20% of what I'm doing, 20% of my activity is going to be short-term, I'm going to have some portion of my income taxed at the short-term rate. So I'm going to have 20% of my portfolio is going to be taxed at 24%, and 80% of my portfolio is going to be taxed at 15%, because 20% of my portfolio is turning over in less than a year, and 80% is being held long-term. Conversely, in mixed strategy 3, 80% of my portfolio is turning over regularly, so 80% of my portfolio times my 24% rate is going to be the effective projected rate, the short-term rate on that particular portfolio and strategy. Not all of it, because not all of it is going to be short-term. That's what we're trying to figure out. In this case, 20% is going to, 80% is short-term, 20% is going to be long-term. So 20% of my portfolio will be subject to the 15% long-term capital gain rate. So these will be calculated for you, but you have to figure out here, like, what's my strategy? What am I actually doing in the market? How much of you just look at your portfolio. How much is turning over regularly? What percentage am I actively trading? And what percentage am I holding long term? And you probably should have different portfolios that do different things. Some are completely long term, some are completely active, and some are one of these types of things in between. So once you figure out all of these codes that you just remember, these are just made up codes. You just put in something that makes sense. These codes will be used up here in this table to pull the rest of the information out of here and populate the projected return for each of these strategies. So just as an example, regular brokerage 2 has been assigned the mixed strategy. You have to type in what you want right here so it can pull the numbers out of the table. So I assigned mixed strategy 1 to regular brokerage 2. Mixed strategy number 1, which is right here, has a 5% projected investment return, which gets pulled up to right here. It has a 4.8% projected short-term rate on the percentage of my portfolio that's going to be short-term. That goes here. 12% long-term rate here because only a certain portion of my portfolio is going to be subject to long-term capital gain. Okay? And that continues just based on how you assign right here. You assign a code to each of these as you try to optimize your strategy, and it'll pull the data in for you. The things that won't change are there's no tax in the short term in the traditional IRAs because there's no tax on the activity, but there is an exit tax, and so it will pull your marginal rate up here for the exit tax calculation. For Roth, there's no tax in the trading, and there's no tax on the way out either. So these will stay at 0, and that's why they're grayed out. So with all of that said, these fields right here, these are going to be your output fields for each of the 9 accounts. I have brokerage 1, regular 2, regular 3, traditional 1, 2, and 3, Roth 1, 2, and 3. And then there's a grand total for the regular, traditional, and Roth, and then a full grand total over here. This is the output area right here. And the output is going to come from the annual calculation tables that are down here. And these are just like the ones that you saw in the examples a few minutes ago with Jane and WizKid Billy and all of that. However, I've added a few more columns as well. I have added columns for contribution of external funds because inside of your regular brokerage, inside of your traditional, and inside of your Roth, the Roth 3 Roth ones are way over here, you can certainly contribute external funds in the real world in addition to having a rate of return as well as conversion. So that is an additional column that I put in. But the rest of the columns are just as you saw in the example. It will pull down your opening balance when you start the analysis. If you want to contribute funds, you would type in a number right here for what you contributed during the year. Now, depending on what you're doing in this portfolio, depending on what code has been assigned, it will either calculate tax or it won't. So for example, this is not calculating any tax yearly, whereas this one is. And the reason that that's occurring, this is regular brokerage 1 and regular brokerage 2. Let's go up here. Is because regular brokerage 1 has been assigned the conservative long-term investing strategy, and therefore there is no tax because you're just holding, basically. Whereas regular brokerage 2 has been assigned the mixed 1 strategy. And so on the short-term tax, the tax that's happening every year as you're trading, 4.8% is being pulled down into this portfolio because 4.8% of your return, of your mixed return, right? These are mixed rates that have been calculated in the table above, shows you how much tax is going to be paid on your return in this particular strategy. Now, if you want to do Roth conversions, there's a column for that in each one. You can do the Roth conversions just like you saw WizKid Billy do the Roth conversions. What you do is you just figure out how much, it doesn't even have to be a part of the return. It can just be how much of this portfolio do you want to pull out. So for example, this portfolio, it really wouldn't, I don't know if it would make sense to contribute funds and do a Roth conversion on the same year. So maybe we'll take that out for the moment. But let's just say that we contributed funds for a couple of years as this portfolio is growing. And then in year 3, I wanted to do a Roth conversion. Well, it doesn't have to be the amount of the tax. It can be kind of whatever you want. Like, you know, you can choose what you want to do, and you can play around in here and try to optimize the best thing with the resources that you have available and the balances in these accounts and so forth. So this one had 63,500 plus another 1,905 rate of return. I mean, you could pull out anything. You could say, all right, I'm going to pull $10,000 out of this account, right? You put it in as a negative number, so it reduces the balance of this account. I'm going to use that to pay tax on a Roth conversion. And so then I have to go over to my traditional IRA and say, okay, well, to do a Roth conversion, the money's coming out of an IRA. So this $10,000 is going to go pay the tax. Based on my marginal rate, it would mean that I can do a $41,667 Roth conversion. And so, but that's got to come out of somewhere. It has to come out of a traditional IRA. So we have a column here for the Roth conversion coming out. There is one for contributing funds if you want to do that as well. So the just like in the example with WizKid Billy, the money comes out of the traditional and it goes over here into the Roth, right over here. So the money coming out of the traditional goes over here into the Roth. And again, I am doing it. I have it set up so that if you take it out, let's say at the end of 1 year, it ends up going into the beginning balance of the next year. You could certainly adjust that based on what your actual activity is. If you do the Roth conversion like at the beginning of the year or at the end of the year or whatever, you can, if you did it at the beginning of the year, you can adjust it in here so that either it gets part of the annual return or it doesn't get part of the annual return and so forth. These templates are for you to modify for whatever you are doing. In fact, the entire workbook, the whole point of it is for you to modify it for your own facts and circumstances, because not everybody's situation is going to be the same. In fact, rarely is anybody's situation the same. And so you take the template and you modify it for what you're doing and the kinds of activities that you're performing. And so then when this is all said and done, you can go year by year. You know, you can put a contribution in 1 year depending on if you're doing it or not. If you're taking money out, you can put that in here. Whatever is actually occurring. And as you keep adjusting this year by year, you will hone in on a more and more refined strategy. You can also play around with this. In fact, the whole point is to play around. All the results that are down here in these tables, they'll all get summarized right up here. And so you'll have the ending balance. So each of these ending balances are linked up right to the bottom here at the end. And so you'll have some idea of like, what is this strategy producing in this particular account? And then you'll have an exit tax, if there is one, based on the strategy, an exit tax rate. And then you'll have a tax based on whatever rate gets pulled in there, based on your portfolio strategy. And you'll have an ending after-tax balance for each of these. And so the point would be that as you work on this, as you play around with what are my different strategies, what are my rates of return, what are my projected tax rates, based on how much is going to be subject to ordinary income tax, based on how much is going to be subject to long-term tax rates, you can optimize your strategy between your brokerage, your regular brokerage, your traditional, and your Roth IRA. By the way, I do have another training video on how to use this calculator. The calculator itself and the video and the IRMAA calculator, all of it is included with the personal tax planning template. So if you are interested in that, you can check that out in the link below this video. That's going to do it for today, everybody. As I mentioned, this Roth conversion video series will now be 5 parts long. We just finished part 4. Part 5 will include a variety of topics. We still have to talk about the various 5-year clocks on Roth IRAs. We have to talk about business income, estimated tax payments, and probably a bunch of other stuff. We are also still working toward tracking and maximizing after-tax cash flow. We started doing that with the stock trader calculator by looking at what is the best way to optimize your after-tax cash flow on your various types of accounts and portfolios. But we're just getting started. There's a lot more to do on that, so we have a lot to cover. By the way, if you have any topics you'd like to see discussed in a future video, please drop your suggestions into the comments. I hope you enjoyed this video. Thanks for watching, and I will see you in part 5.